All right, welcome back to Talk Tickers. Today, we're diving deep into D.R. Horton's, ticker DHI, first quarter results for their fiscal 2026. Now, on the surface, this looked like a really solid report, but, and this is a big but, the stock's reaction? Well, that told a completely different story. So let's dig in and figure out what's going on.
So here's the big question, right? Why did D.R. Horton's stock fall after what looked like a solid earnings beat? I mean, this is that classic beat and fade scenario that can drive investors absolutely crazy. The headline numbers looked great, but the stock just couldn't hold on. We're going to get to the bottom of exactly what the market was looking at that caused this pullback. Okay, first things first, let's look at the quarter's key metrics. And really, the headline here is that it was a strong beat. So let's start with the bottom line, earnings per share. DHI came in at $2.03. Now, Wall Street was only looking for $1.93, so that's a really clean 5.2% beat, a nice surprise to the upside for sure.
And it wasn't just the bottom line. The top line, the revenue, was just as strong. They brought in almost $6.9 billion. The street was expecting closer to $6.6 billion, so that's another solid beat, up 4.7% versus the forecasts. So you can see, check and check, both earnings and revenue, clear beats.
And when you peel back the onion a little bit, the story just gets better. The operational strength was there too. I mean, look at this. Net sales orders were up 3% year over year. They generated a ton of cash from operations, over $850 million. Their cancellation rate held steady at 18%, which is pretty good in this environment. And the balance sheet? It's just rock solid, with a super low debt-to-capital ratio. Bottom line, these guys know how to run their business.
Okay, so if the quarter was so darn good, what gives? Why the drop? Well, this is where the plot thickens. Because the market, as it often does, looked right past the rearview mirror and focused squarely on the road ahead. And that road, specifically the guidance on margins, that's the real reason for the fade.
And here's the first clues smart investors picked up on. You see that reported gross margin of 20.4%? Well, it wasn't quite as good as it looked on the surface. Turns out it got a little boost, about 40 basis points, from a one-time warranty cost recovery. So if you strip that out to see what the real operational margin was, it was actually closer to an even 20.0%.
And this slide right here, this tells the whole story. This is what the market really cared about. After posting that underlying 20% margin in the first quarter, look what they guided to for the next quarter, just 19 to 19.5%. That's a pretty big step down, and that is exactly what spooked investors and put pressure on the stock. So you gotta ask, why the drop in margin? Well, management was super clear about this on the call. They said incentives are expected to stay elevated for the rest of the year. You know, we're talking about things like mortgage rate buydowns, where they basically pay to lower the buyer's monthly payment to make the home more affordable. And while that's great for moving houses, those incentives come right off the top, eating directly into their gross margin. So the market is definitely cautious. How is D.R. Horton planning to navigate this? Well, they're not just sitting on their hands hoping things get better. They've got a very clear strategy, a playbook they know how to run in this kind of environment. And here's what their affordability playbook looks like. First, it's all about finding that sweet spot between sales pace, price, and how many incentives they have to offer. And they do this market by market, which is really smart. Second, they're leaning hard into what they do best, building smaller, more affordable homes. Third, like we talked about, they're using those financing buydowns to help people actually afford the monthly payment. And through it all, they're laser focused on being super efficient with their money and delivering returns for shareholders. And if you want proof that their strategy is working, just look at who they're selling homes to. A whopping 64% of their mortgage closings this quarter went to first-time home buyers. That's huge. This isn't an accident. This is their bread and butter. Their whole business model is built to serve this customer who isn't just looking, they need a place to live. All right, so we've looked at the good and we've looked at the, well, not so good. So what's our take on DHI going forward? It's time for the next call, our look ahead at what to expect. So our rating on the stock is market perform. Look, there's no doubt that D.R. Horton is one of the best home builders out there, an absolute best-in-class operator. But those margin headwinds we've been talking about are very real, and right now it feels like the stock price is reflecting that reality pretty fairly. Okay, so here's our thesis in a nutshell. What are we watching next quarter? For revenue, we think they'll hit their guidance. Their execution is just too solid and disciplined, so we think that's achievable. But for gross margin, that's where we see the pressure. We expect them to come in right at the low end of their guidance, around 19%, simply because those incentives aren't going away anytime soon. So what does that mean for the stock price? Well, we think it's probably going to be pretty range-bound for a while, basically trading sideways as the market tries to balance their great execution against that margin pressure. The big wild card here, the question all Lenser wants an answer to, is whether the spring selling season will be strong enough for them to start easing up on those incentives. That's what we'll be watching.
And of course, a quick reminder, this is not financial advice.